Jeff, right before we came on air, you guys have just put out a statement about Marvell Technologies. You've increased your position from 5.2% to 5.9%. What do you want to see change there?
Yeah, thanks for having me, Ed. It's nice to be here. So Marvell's a company that we know well. A few years ago, we got involved for the first time. The company was having some issues. They had an options backdating scandal. They had a whole bunch of CFOs that needed to turn over. They actually had trouble with their financial statements. And we made an investment and worked with the company to actually replace a good number of board members. At the end of the day, there are 7 out of 8 new board members from when we got involved. And then we brought in a new management team. So it's gone really well. We know the company really well. We brought in the management team. We think they've executed incredibly well. We actually have done the heavy lifting of the activist part of it. My partner, Peter Feld, was on the board. He no longer is on the board. But we have a lot of confidence in the company, its prospects, and the management team. And then they announced an acquisition of Cavium, which really is a terrific acquisition, which diversifies their portfolio into infrastructure and networking. Previously, there were more storage. We think that that's terrific. It adds to the growth rate of the business.
The contention is what? That the market doesn't think it's as terrific as you do?
Well, the stock has more than doubled since when we first got involved. And then when the Cavium acquisition was first announced, the market actually loved the acquisition. The stock was up another 30% on that, but it's retraced. It's retraced all the way back to actually below the price where the deal was announced. And we think that there's some misconception in the stock. So
what do you do to convince other investors?
Well, for us, this is an investment. We have a high confidence level in the company, and we saw this as an opportunity to talk about it. I'm going to present it at the conference here at Capitalized for Kids and talk about why the company is undervalued. But in short, it's a great company, a fantastic management team that keeps executing really well. It's about a 10% free cash flow yield. And that's based off of the numbers that the company just presented at their Analyst Day, which I believe was last week. But importantly, the company announced or projected those numbers using just the revenue that they could see. And then they talked about how they were investing in several different call options in their business. So one of them is the revenue synergies they're not counting between Cavium and Marvell, but obviously there should be revenue synergies from putting these two companies together. They also have an investment in 5G, and as that rolls out, they're spending a good amount of money on that. We would presume they're going to get returns on that investment, but that's not in their projections, but the costs are in their projections. So, and they also have come out now with the first ARM server, which is an alternative to Intel's server chip. So they have a lot going for them, but the market is still valuing them based on, possibly lower numbers.
All right, so let's move on from the single name. You and I have talked in the past about how often when you do these kind of interviews, it is a sort of merry-go-round of which names you're looking at, which names you're in. Let's talk more generally. You've described your own investment philosophy as being value, path, plan. I hope that's the right order. The value piece of that is fairly sort of self-evident to me. Explain the path and the plan. What do they mean to you, and which is most important when you're picking stocks?
Yeah, so at Starboard, being an activist, it's important to have this discipline, which is you can't get involved in a company unless you have all 3 elements. But to your point, Ed, value changes every day in the marketplace. So a company is going to be cheap or not cheap, and it's going to move around, but we're going to look at companies that we think are cheap or are going to be cheap.
Pro forma, right?
Cheap
because it's what you can do.
What we're going to do, exactly right. So the plan element is that we have to know that we're going to be able to do something different than what management's already going to do. So something that they're not planning on doing, we're going to do that's going to create value at the company. Most of the time, that means improving cash flow significantly. And then the path, which is critically important as an activist, is we can't assume that management is going to be willing to do what we say. We have to assume the worst case, which is that management is going to dig in their heels and be unwilling to do what we say, and we can't get stuck. So the path means if management is unwilling to work with us, do we have a clear path to be able to make the change anyway, which usually means can we run and win a proxy contest in order to be able to make the change?
Now let's talk about that, because that's interesting. You guys are known, Starboard are known for running and winning proxy contests. You've run more than anyone else, you've replaced more board members than anyone else. But since Darden in 2014, when you knocked over the whole board of the company, you haven't run a single one. Does that tell us that corporate America is getting too soft?
We've been trying, but I don't think so. I actually think that what's happened is companies and their advisors have gotten really smart.
Smart or conciliatory? Because it seems like if activists aren't having to go to the mat anymore.
I'd like to say smart, because what happens is they're actually identifying which shareholders they need to listen to and which shareholders they may choose to listen to. And we end up in the camp, I believe, of the ones that they need to listen to. So what happens is, if we get involved in a company, they're going to immediately, like anyone would, they're going to call people that they know who know us. So that could be other people at other companies, whether it's management or board members. It could also be their advisors, proxy solicitors, bankers, attorneys, whomever. It's going to be very, very easy at this point in time. We've been doing this now for 17 years. It's going to be very easy for them at this point in time to find someone, one degree of separation, that has worked with us and knows us. And what they're going to say to them is, Starboard is real. They're good at what they do. They're serious. They really do just care about what's in the best interest of the company and creating value.
And if you don't do what they say, they might run a proxy fight and take your job.
So you might as well work with them, and you might as well listen to their ideas. So that's on the good side. But then on the other side, you're right, Ed, they're also going to say, and they will follow through, and they're serious, and they will run a contest, and most likely they're going to win. So if you're going to have to work with them one way or another, you may as well try and figure out if there's a way to work with them without going through the contest. And that's what we've found. In the last 4+ years, we've been trying to run contests. We get involved in companies where we think we may have to. We certainly need to have the clear path. But in each situation, we're also reasonable. If we find a management team or a board that we come to and we say, your company is undervalued, we want to help, and we have ideas, and we believe we can help, more often than not now, those companies are actually saying, okay, let's see if there's ways we can do it. There are things that we think we can do to improve the business also. Maybe this accelerates that process and that plan. We knew we needed to do some things differently. Maybe we need to do it faster. And you know what? Maybe you guys, based on your experience, really can help us.
Okay, so let's talk about when an investment doesn't go the way you want it to go. How do you balance the reputational risk of walking away and therefore looking kind of toothless versus just getting out of a bad investment?
Right. So
because you guys are not normal economic interest. You are, you're in there, but you're proclaiming an alternative version of progress to the other investors or to the board and management.
We do believe we have a higher burden. So, our job is to represent the interests of the shareholders. The board's job is really to represent the interests of the shareholders, but the reason we have an opportunity is because in some situations, the board isn't necessarily hearing the shareholders, and they may not be representing the interests of the shareholders to the shareholders' liking. Right? That's the disparity. Why do we have an opportunity to get involved in a company? It's because the shareholders are unhappy with their representation.
I want to pull you on that, right? Yeah. So we've talked about this in the past, long-onlys being sort of more involved, not only in the processes, but in coming to you with ideas. How many of the Starboard ideas today come from long-onlys?
A lot of our ideas come from long-onlys.
Roughly percentage?
So we don't really keep track of the percentage, but what I will tell you is we get a lot of phone calls. We get a lot of phone calls from frustrated shareholders, which would make sense. Every day. Which would make sense, because if you're invested in a company and it's going in the wrong direction and management doesn't feel like they're doing the right thing, they want to have somebody that they can complain to, and somebody preferably who can do something about it, and we're that phone call.